Have you ever landed at an airport, stepped off the plane, and just, thought about the sheer complexity of the place? The runways, the terminals, all the shops, this whole ecosystem that just works.
Mm-hmm.
It's a truly fascinating world, especially when you consider that many of these massive hubs aren't actually run by governments.
Right.
Instead, they're operated by private companies, sort of the unsung heroes managing our global connections. I remember once having this 5-hour layover and realizing the entire mini city I was in was someone's business.
Yeah, that's a perspective shift, isn't it?
It really got me thinking. Imagine owning a piece of the sky, or, well, at least the ground underneath the planes.
A tempting thought.
So today, we're taking an in-depth look at one of those fascinating entities. Corporation América Airports S.A., or CAA, that's listed on the NYSE under the ticker CAAP.
Right, CAP.
And this isn't just any operator, it's actually one of the world's largest private airport operators, measured by the sheer number of airports it manages.
Quite a portfolio.
Our mission for this deep dive is to explore CAAP's multifaceted investment profile. We're going to, uncover its foundational strengths, its truly unique business model, and critically, its significant exposure to the macroeconomic and political currents of its primary market, Argentina.
Mm-hmm.
We'll extract the most important nuggets of knowledge from a detailed investment research analysis we've gone through to help you understand what's truly important here. So when we consider a company like CAAP, what's the bigger picture here? What are we really exploring beyond just planes and runways?
Absolutely. I mean, what's fascinating here is that CAAP isn't just a collection of airports. It's really a masterclass in navigating diverse regulatory environments and leveraging these almost monopolistic positions they have.
Okay.
But, and this is key, it also presents a unique leveraged play on the trajectory of an entire nation.
Wow.
So the core insight for you, the listener, is that we're talking about long-term infrastructure, geopolitical chess, really, and the very economics of how we connect globally.
That's a great way to frame it. So let's start by understanding exactly what CAAP is and the business of airports at a global level.
Okay. At its core, CAAP is a formidable player in the global infrastructure landscape. Its scale is truly impressive. It operates 52 airports across 6 countries.
52.
Yeah. This isn't just a regional player. It's a significant global force in private airport operations. And the assets themselves, these are long-term infrastructure assets, often inflation-protected and critically protected by exceptionally high barriers to entry.
High barriers to entry. What does that mean exactly in this context?
Well, think about it. You can't just decide to build a new airport next door to an existing one, right? The costs, the land acquisition, the regulatory hurdles, they're astronomical. It's just incredibly difficult.
So these are essentially permanent, vital assets, incredibly difficult for anyone else to replicate. How does CAAP actually operate them and, more importantly, make money from them? What's their core business model?
Their core business model is built on concessions. So what this means is CAP acquires, develops, and operates these airport concessions under long-term agreements with government entities.
Okay.
This grants them a quasi-monopolistic position within their designated service areas. Think of it like being the only gas station on a long stretch of highway legally protected from direct competition in your immediate area for the duration of the contract.
Right, like an exclusive, right.
Exactly. That's their fundamental economic moat, as they say. It's incredibly difficult for new competitors to emerge because these are long-term exclusive contracts.
So they're essentially locked into these deals, which sounds great for stability. And how do they actually generate revenue from these quasi-monopolies? Is it all just fees from airlines landing planes?
Not at all. It's actually a bifurcated revenue structure, which is quite strategic.
Yeah.
You have what are called aeronautical revenues and then non-aeronautical or commercial revenues.
Okay, 2 buckets.
2 main buckets. Aeronautical revenues come from fees for using essential airport infrastructure, things like passenger usage fees, which are charged per departure or transit, aircraft landing fees, and parking fees for the planes.
Got it. The basics.
The basics, yeah. And these are typically regulated by government authorities and are directly tied to passenger and aircraft movement. We saw solid growth here, 6.8% year over year in the first quarter of 2025.
Okay.
But what's particularly interesting is that in the fourth quarter of 2024, these revenues actually grew 1.7%, even as overall traffic declined slightly.
Huh. How does that work?
It tells you they were benefiting from positive effects of tariff adjustments, getting price increases through, and also a shift towards higher fee international travel. more profitable passengers, basically.
That's a smart detail, even if fewer people are flying overall. If the ones who are flying are on international routes with higher fees, revenue can still grow. So what about the other side, the non-aeronautical revenues?
Right, the non-aeronautical or commercial revenues. These are the higher margin activities, and they're really a key focus for value creation for CAP.
Okay, so this is the shopping, the food.
Exactly. Everything from duty-free and retail stores, food and beverage outlets, car parking for passengers, VIP lounges, advertising space, and even the development of ancillary real estate like cargo and logistics facilities near the airport.
Wow, quite a range.
It is. And these revenues are linked more to passenger spending habits and, frankly, CAP's effectiveness as a commercial manager, how well they run the shops and services. They showed strong growth, too, up 6.1% in Q1 2025.
And why are these so important? Higher margin.
Precisely. These are crucial because they offer much higher margins than the regulated aeronautical fees. This gives them more flexibility and boosts overall profitability significantly.
It sounds like a landlord-tenant relationship almost, but on a massive, massive scale. And these concession agreements, how long do they typically last? Are they truly long-term?
Oh, absolutely long-term. And that's really the cornerstone of their business model. It provides a durable and predictable framework for operations and investment.
Okay.
But it's not passive.
Yeah.
COP has a demonstrated track record of actively managing these concessions. They've successfully negotiated extensions for key assets. For example, their cornerstone Argentine concession was extended by 10 years out to 2038 now.
10 years, okay.
And their Montevideo concession in Uruguay got a 20-year extension all the way to 2053.
Wow, 2053, that's long.
It really is. And these extensions provide the certainty needed to undertake those big, long-term capital improvement projects. You need that visibility.
That sounds incredibly stable, securing decades of future cash flows. But you mentioned a significant vulnerability earlier. What is that, despite these long-term contracts?
Well, the inherent vulnerability is that while these agreements provide stable cash flow, they are ultimately with sovereign governments.
Ah, right, the government factor.
Exactly. This makes CAAP intrinsically dependent on the political stability and, frankly, the fiscal discipline of its host nations. This creates a concentrated political risk that even their operational excellence cannot fully mitigate.
So on paper, they operate in 6 countries, which sounds diversified. But how does that geographic spread actually translate to their risk profile? Is it truly diversified, or is there a catch?
That's where it becomes a bit of a study in contrast, you could say. While they do span developed European markets and high-growth, high-volatility emerging economies, there's a significant imbalance.
Imbalance how?
Their operations are heavily weighted towards Argentina. Argentina operates 35 of its 52 airports.
35 out of 52, okay.
Yes, and it contributes the majority of its earnings before interest, taxes, depreciation, and amortization, or EBITDA. EBITDA is a key measure of a company's operational profitability.
Got it.
So this means EPAP's consolidated results, the overall company performance, are disproportionately influenced by Argentine economic and political dynamics.
So Argentina is really the tail wagging the dog, so to speak, in terms of its impact. Is there anything that counterbalances this heavy weighting?
Precisely. The European assets, particularly the airports in Florence and Pisa in Italy, act as an important counterweight.
Okay.
They operate in a much more stable, mature market and offer a different risk-return profile. So they provide a partial hedge against that Latin American volatility.
Makes sense.
And it's worth noting the company has made strategic adjustments. Like back in 2021, they divested 5 Peruvian airports to sort of focus on what they deem their core, high-potential assets.
So they're actively managing the portfolio mix.
Yes, it shows a disciplined approach to capital allocation.
And how has passenger traffic been, post-pandemic? Are people flying again in these regions? Is the recovery solid?
The post-pandemic recovery has been quite strong, actually. CAP served 79.0 million passengers in 2024.
79 million?
Which is equivalent to about 93.8% of their 2019 traffic levels if you exclude the terminated Natal concession in Brazil, which sort of skews the comparison.
Okay, almost back to pre-pandemic levels then.
Pretty close. And if you do exclude Natal, traffic was only down 0.4% year over year in 2024. So that indicates a stable underlying performance across their remaining portfolio. The key insight here is the swift and significant rebound in air travel, which lays a strong foundation for their revenue generation.
So you're looking at a company that essentially owns gateways to countries, collecting fees from everyone who passes through. It sounds like a dream business, but then you mentioned this critical dependence on governments. That's where it gets really interesting, isn't it?
It absolutely is. And that dependence brings us right to how these airport concessions are actually regulated, because it varies significantly by country, and that directly impacts their revenue and return potential.
Okay, let's unpack that regulatory maze. You said they operate under 3 distinct regulatory models. How do those work, and what are the implications for CAAP's ability to generate returns?
This is crucial, yeah, because these frameworks directly dictate CAAP's revenue potential and its return on investment. The profound insight here, I think, is that CAAP isn't just operating airports. It's a masterclass in regulatory arbitrage and relationship building.
Right.
Their ability to not only navigate, but also to negotiate favorable terms across these disparate frameworks is a formidable, almost unreplicable, intangible asset.
So what's the first model?
Okay, first we have the single till model. This accounted for about 68% of their 2024 revenue. It's prevalent in Argentina and Armenia.
Single till, got it.
Under this model, the airport is regulated as a single entity, and the operator aims to achieve a target internal rate of return, or IRR. IRR is essentially the projected annual rate of return an investment is expected to generate over its entire life.
Okay, a target return.
Exactly. And the key feature here is that it provides a contractual mechanism to renegotiate tariffs or other terms if major macroeconomic shocks, like a significant currency devaluation, for instance, threaten the economic equilibrium of the concession.
So it's designed to protect them from those wild economic swings, at least in theory. Which sounds vital in a place like Argentina.
It is vital. It's designed to protect their profitability over the long haul, but it requires negotiation.
Okay, what about the next one?
The second model is inflation-based, making up about 24% of their 2024 revenue. This is used in Brazil, Uruguay, and Ecuador.
Inflation-based. Makes sense for LATAM.
Right. Here, tariffs can be adjusted annually based on a domestic inflation index or some kind of parametric formula.
Okay.
The significant benefit of this model is pretty clear. It provides a direct and powerful hedge against inflation. That's particularly valuable in Latin American markets, which are often prone to higher inflation rates. They can pass through cost increases directly.
That makes a lot of sense for those regions, providing a built-in hedge. And the third model?
The third is the dual-till regulated WACC model. This represented about 8% of their 2024 revenue. This is more of a conventional utility-style regulation, and it's used in Italy for their Florence and Pisa airports.
Okay, the Italian model.
Right. Here, aeronautical charges are determined periodically based on a regulated asset base and an allowed weighted average cost of capital, or WACC. WACC represents the average cost of all the capital a company uses, both its debt and its equity.
So more like a traditional utility company.
Exactly. This model provides a more predictable, though perhaps less flexible, earning stream. It's often found in more mature, stable markets like Italy.
So they're managing 3 very different sets of rules, each with its own benefits and drawbacks for their bottom line. That truly speaks to the depth of their institutional knowledge, doesn't it?
It absolutely does. I mean, CAAP's ability to not only operate within these disparate frameworks, but also to successfully negotiate favorable terms and extensions, it really showcases deep institutional knowledge and strong cultivated government relationships. This is a significant intangible asset, a real competitive edge.
To give our listener a clearer picture, let's dive into some specific examples from their actual airport portfolio. How do these different regulatory models play out in practice across their key assets?
Certainly. Let's look at Argentina first, where they manage critical airports like Ezeiza and Aeropark in Buenos Aires.
The big ones.
The big ones, yeah. These accounted for over half of CAAP's total traffic last year, about 40.5 million passengers. The concession here extends to 2038, and it operates under that single-till regulatory regime we just discussed.
Okay, single-till in Argentina.
Which means their returns are designed to be protected against macroeconomic shocks. But crucially, they need to actively renegotiate terms, which requires that strong relationship with the government.
Got it. Where next? Italy.
Let's jump over to Italy. Yeah, airports like Florence and Pisa, they handled about 9.0 million passengers in 2024, representing around 11.4% of CAAP's total traffic.
Okay.
Their concession extends much further, all the way to 2046, and these airports operate under the dual-till regulated WACC model.
Utility model.
Right. So a more predictable, but maybe less flexible earnings stream, reflecting Italy's more stable economic environment.
And Brazil. You mentioned that uses the inflation-based model.
Exactly. For a different flavor, consider Brazil, with Brasilia Airport. It accounted for 14.8 million passengers, or about 18.7% of total traffic, with its concession expiring in 2037.
Okay.
This operates under the inflation-based model, providing that direct inflation hedge we discussed, which is highly beneficial given Brazil's economic characteristics over the years.
So when you look at these examples, you really see how each regulatory regime impacts the business differently. Argentina needs negotiation, Italy is stable but maybe less upside, Brazil tracks inflation. This raises an important question. When you have different regulatory rules for different airports, how much flexibility does a company truly have to adapt to economic shifts, especially in places prone to volatility?
That's a critical point because it's not just about managing an airport. It's about managing a portfolio of airports, each with its own distinct rulebook.
Yeah.
And this leads us perfectly into the broader Latin American aviation landscape and how CAAP positions itself competitively within it.
All right, let's talk about that landscape. Is it growing? What are the dynamics?
The Latin American aviation market is definitely experiencing a significant growth phase. It was valued at approximately $38.6 billion in 2024.
Okay.
And forecasts suggest it's set to grow at a compound annual growth rate, or CAGR, of about 4.4% to reach an estimated $59.3 billion by 2034.
Healthy growth. What's driving it?
Several things. An expanding middle class with more disposable income for travel, significant government and private sector investment in airport modernization and tourism promotion, and just overall improved air connectivity across the region. More routes, more flights.
And a big part of that growth, especially in emerging markets, is often driven by low-cost carriers, isn't it? They've really changed the game globally.
Absolutely. The proliferation of low-cost carriers, or LCCs, think names like Viva Air, JetSmart, Volaris, has fundamentally altered the market in Latin America.
How so?
Well, they've made air travel far more affordable and accessible to a broader segment of the population. This, in turn, stimulates demand and increases competition within the airline industry. And for airport operators like CIP, more passengers means more business. It's a massive tailwind.
That sounds like a powerful tailwind. Has the region seen a strong post-pandemic recovery reflecting these trends? Are the numbers actually showing that growth?
It has indeed. The International Air Transport Association, IATA, reported that international passenger demand for Latin American airlines surged by 8.8% year-over-year in May 2025. Capacity was up even more, 11.0%.
Strong numbers.
Very strong. And earlier, back in January 2025, regional traffic was already 2.4% ahead of the prior year. So this consistent, strong recovery provides a very favorable environment for airport operators like CAP. The trend is clearly upward.
So they're riding a wave of growth in a dynamic market. But beyond the market itself, you mentioned something earlier called a formidable competitive moat. Can you elaborate on what makes their position so strong, almost unassailable?
Right, the moat. The airport operation business is essentially characterized by what economists call natural monopolies.
Natural monopolies.
Yeah. It means there are extremely high barriers to entry, making it incredibly difficult for new competitors to emerge. First, there's the sheer capital intensity involved. We're talking billions of dollars for land acquisition, building runways, terminals, all the associated infrastructure. Just huge sums of money.
Billions. Okay.
Second, the regulatory hurdles are immense. Gaining permits, environmental clearances, political approvals to build a new airport is often a multi-decade endeavor, if not practically impossible in many urban areas. Where would you even put it?
Good point.
And finally, their concession exclusivity. Remember those long-term contracts. For the duration of their contracts, CAAP legally precludes direct competitors in the same city or region. It's written into the deal.
So those are the structural barriers, the physical and legal impossibilities of building a competing airport. But does CAAP have any intangible assets that reinforce this moat? Things that can't just be bought or built overnight?
They absolutely do. This is crucial. CAPP has deep, long-standing relationships with governments and regulatory bodies across its jurisdictions. These have been cultivated since its first major concession way back in 1998.
Decades of relationship building.
Exactly. This experience is critical for navigating the complexities of contract negotiation, renewal, ongoing regulatory compliance. It's a significant competitive advantage that new entrants simply can't replicate quickly. It's that institutional knowledge of the network built over decades.
Given all this, the moat, the relationships, how much pricing power do they actually have with the airlines, especially with the trend of airline consolidation happening across the globe? Could bigger airlines push back more?
That's a good question. Their pricing power isn't really market-driven in the traditional sense. It's strictly defined by their concession agreements, as we discussed with the regulatory models.
Right, the rules are set.
In inflation-based regimes, they have a direct contractual ability to pass on inflation. In single-till regimes like Argentina, they have the right to seek tariff adjustments to ensure they achieve their target IRR. That's a powerful mechanism to protect their economic value from macroeconomic shocks or cost increases.
So the contracts give them leverage.
Yes. And while airline consolidation could theoretically increase the bargaining power of the airlines, CAP's hub airports, think Ezeiza in Buenos Aires or Brasilia, are essential gateways. Airlines simply cannot effectively serve a country without access to its primary airports.
They have to use them.
Pretty much. CAP further mitigates this risk by maintaining a diversified portfolio of airline clients, and importantly, they have growing exposure to that rapidly expanding LCC segment. So they're not overly reliant on any single traditional carrier. Airlines arguably need CAP more than CAP needs any single airline.
That makes sense. But the rise of LCCs, while good for passenger volume, can also be a bit of a double-edged sword for airport operators, can't it? Are these LCC passengers spending as much on those high-margin services like duty-free?
It's what we sometimes call the LCC paradox for airport operators. On the positive side, LCCs are powerful engines for passenger volume. More people flying directly increases aeronautical revenue from passenger fees and landing fees. That's an unambiguous positive for C.
And more volume is good.
Absolutely.
Yeah.
However, the flip side is that LCC passengers are often more price sensitive. They typically spend less per capita in those high-margin non-aeronautical areas, duty-free, upscale food and beverage, VIP lounges.
Right. They're watching their wallets.
Exactly. So while overall traffic grows, the growth in revenue per passenger might be more modest or harder won. This presents a strategic challenge for CIP. They must adapt their commercial offerings to effectively monetize this growing but often more frugal passenger segment. They need to figure out how to capture as much of that non-aeronautical value as possible, even from budget travelers.
Here's where it gets really interesting. You got this incredible, almost unassailable competitive position because of the nature of airports, but then you layer on the unique dynamics of a market segment like LCCs. It's like having a gold mine, but you need different tools to extract all the value. Now, let's pivot to the numbers. How has CAAP's financial health been, particularly given the strong post-pandemic recovery and the specific challenges of its operating environments?
Okay, a deep dive into CAAP's financials reveals a company navigating a pretty complex environment with, I'd say, resilience. Looking at their historical financial trajectory from, say, 2021 to 2024, we see a strong rebound. Total revenue surged from about $707 million in 2021 to $1.84 billion in 2024. Huge jump, reflecting that sharp recovery in air travel. And this top-line growth translated directly to the bottom line. Net income swung from a loss of $181 million in 2021 to a profit of $308 million in 2024.
From red to black, significantly. But you've mentioned before that interpreting these figures requires some nuance, especially regarding Argentina. Can you explain the IAS 29 hyperinflationary accounting challenge? That sounds like something that could really distort the numbers.
This is absolutely critical for investors to understand. The application of the International Financial Reporting Standards Rule IAS 29, which deals with hyperinflationary economies, materially impacts the reported results coming out of Argentina. It often masks the true underlying performance.
It masks it how?
Okay, for example, in Q1 2025, CAAP reported that consolidated revenues excluding certain IFRIC 12 adjustments, which are just specific accounting interpretations for concession arrangements that can sometimes complicate direct comparisons, grew by 6.4%.
Okay, 6.4%.
But if you strip out the effects of IAS 29 accounting, the underlying growth was actually a much stronger 11.5%.
Wow, nearly double.
Exactly. The core insight here is that for CAAP, the reported U.S. dollar figures can dramatically understate the true, robust growth happening on the ground in Argentina in local currency terms. Investors must look beyond the headlines to the ex-IAS 29 figures the company provides. They're your real window into operational performance.
That's a huge distinction. It means the headline numbers don't always tell the full story. What about their profitability and margins? Are they expanding as revenue grows, or are there pressures there too?
Profitability, which we often measure using adjusted EBITDA, has also recovered, but we are seeing signs of pressure more recently. In Q1 2025, the adjusted EBITDA margin was 37.3%. That's actually contraction from 41.7% in the prior year quarter.
Okay, why the squeeze?
Management attributed this primarily to inflationary pressures in Argentina, where peso-denominated cost increases were outpacing the rate of currency depreciation at that time, and also some adverse foreign exchange translation effects in Brazil and Italy.
So costs rising faster than revenue adjustments in some places.
In that specific period, yes. And it's also really important to remember, just for context, that EAP's Q4 2023 adjusted EBITDA was significantly inflated by a one-time event.
Oh, right. You mentioned that earlier. The natal payment.
Exactly. A one-time gross indemnification payment of about $166.5 million related to the natal airport concession termination in Brazil. You had to exclude that for any meaningful year-over-year comparison. It was a one-off windfall, not recurring profit.
Got it. So if we look at the trends for total revenue, net income, passenger numbers, and that key metric, revenue per passenger, from 2021 through 2024 and into early 2025, what overall story do those numbers tell us?
Okay, when we examine that financial trajectory, the recovery is unmistakable. Total revenue climbing from roughly $707 million in 21 to $1.84 billion in 24, clearly showing the strong rebound. Net income, as we said, that dramatic swing from $181 million loss to a $308 million profit. Total passengers almost doubled over that period from 35.7 million to 79.0 million, demonstrating the return of air travel.
Right.
And crucially, revenue per passenger, which is that critical indicator of their ability to monetize the traffic, shows a positive trend. It improved to $19.03 in 2024 and actually reached a post-IPO high of $20.06 back in Q1 2024. This consistent improvement signals a successful commercial strategy. Despite that LCC paradox we discussed earlier, they're getting more dollars per person on average.
Okay, that's a key positive sign. How does their balance sheet look? Are they well-positioned financially to handle any economic shocks or fund future growth? An infrastructure company like this needs a strong financial foundation, right?
Absolutely. A robust balance sheet is a critical buffer, especially for a company operating in volatile markets like some of KP's. And they are in a strong position. As of March 31st, 2025, they had $448.6 million in cash and cash equivalents.
Healthy cash position.
Yes. And more importantly, perhaps their leverage is low. Net debt was around $718 million at the end of Q4 2024, and their net debt to LTM adjusted EBITDA ratio, that's net debt compared to the last 12 months of adjusted EBITDA, was a very manageable 1.1x.
1.1x, that is low for an infrastructure company.
It is quite low. This provides a significant buffer against macroeconomic shocks and really enables future growth. This financial strength gives CAAP strategic flexibility. They can confidently pursue ambitious capital expenditure plans without stressing their balance sheet or needing to issue potentially dilutive equity financing.
And it helps when bidding for new airports, too, presumably. Shows they're solid.
Exactly. It gives them a competitive advantage when bidding for new concessions, as it demonstrates financial credibility to potential government partners.
And what about shareholder returns? Given that strong balance sheet, are they prioritizing dividends or are they reinvesting in the business?
Currently, their focus is squarely on reinvesting for growth. They are not presently paying a dividend. The priority is funding those significant expansion projects we'll talk about and prudently managing the balance sheet to support future opportunities.
Okay, makes sense with big projects ahead. Beyond the big financial numbers, what are the key operational efficiency indicators maybe to watch for this company? Any other areas showing interesting trends?
Well, beyond revenue per passenger, which we touched on as being critical, cargo operations are an emerging growth vector. Volumes grew a healthy 16% year-over-year in Q4 2024 and another 9.1% in Q1 2025.
So diversifying beyond just passengers.
A bit, yes. It helps diversify revenue streams. But the key insight here, circling back, is that while the overall numbers show a strong recovery, the details reveal a business operating in an incredibly complex financial environment. Understanding those nuances, like the IAS 29 adjustments and that one-off needle indemnification, is really key to grasping the true health and growth trajectory of the company. It's definitely not a simple income statement to read at face value.
That's an excellent point. It really highlights why this kind of deep dive is so important for investors. Now let's shift gears and look forward. What are CS transformative projects and future horizons? Where do they see their next big leaps in growth coming from?
Okay, future growth. CAAP has a multi-pronged growth strategy. The most fundamental aspect is just capitalizing on the organic tailwinds.
Meaning just more people flying?
Essentially, yes. The continued expansion of air travel in CAP's core markets is significant. The Latin American aviation market, as we discussed, is projected to grow at a multiple of regional GDP. That's fueled by the rising middle class, LCC expansion. IATA forecasts also continue to show strong demand growth for the region. So that provides a powerful secular tailwind for CAP's passenger volumes.
So it's about more people flying, certainly, but also it's about how much they spend once they're in the airport, right? How are they trying to maximize that piece?
Exactly. Beyond simply riding the wave of traffic growth, management is intensely focused on increasing the monetization of each passenger, particularly through the expansion of those high-margin non-aeronautical revenues.
Okay, specific examples.
They have concrete initiatives. In Argentina, for example, they're expanding the duty-free area at Ezeiza International Airport by over 50%. That's significant.
50% bigger, okay.
Yeah. In Brazil, they've inaugurated a new logistics center and are developing further real estate projects near their airports. And across their whole network, they're constantly optimizing their tenant mix, enhancing offerings in retail, food and beverage, VIP services, all designed to drive higher commercial revenue per passenger. It's a very deliberate strategy to capture more value from every traveler walking through their terminals.
Those sound like good, steady growth drivers,
Yeah.
incremental improvements. But what about the really big projects, the transformative ones you mentioned earlier, the ones that could really move the needle for the entire company?
Right. These are arguably the most significant potential catalysts for the company.
Yeah.
2 major expansion projects in their European and Eurasian segments. These aren't just, fixing things up. They're large-scale developments designed to fundamentally alter capacity and earnings power.
Okay, lay them out for us. First one.
First, there's the Florence Airport in Italy. This is a massive $497 million complete overhaul.
€500 million.
Yeah. It includes a new state-of-the-art passenger terminal and, crucially, a new, longer runway.
Yeah.
They're extending it to 2,200 meters from about 500 and 560 meters now.
Why is the longer runway such a big deal?
That runway extension is a potential game changer because it will allow the airport to accommodate larger aircraft and therefore longer haul flights. This could open up entirely new routes and markets directly into Florence, which is obviously a huge tourist destination.
Okay.
The project is expected to more than triple the airport's capacity to 8.0 million passengers annually. It's slated for completion around 2028. This could dramatically increase both aeronautical and commercial revenue potential from a key European asset.
That's a huge undertaking. And the other one in Armenia is equally ambitious, right?
It is. The second big one is the Zvartnots Airport in Armenia. CAP is planning a massive U.S. $425 million capital expenditure program for its main airport there, scheduled mainly for 2026 through 2028.
Another huge investment. What's the goal there?
This investment aims to more than double the terminal area and significantly expand the commercial spaces within it. The goal is to increase the airport's capacity from approximately 3.5 million passengers currently to potentially 10.0 million passengers.
Wow, almost tripling capacity there too.
A huge increase. And this project is currently progressing through the final stages of government approval, which is a key milestone for investors to watch.
These projects sound absolutely pivotal to the investment thesis. What would their successful completion mean for CAAP's overall profile if they pull these off?
They are indeed pivotal. Their scale is substantial relative to CAAP's current enterprise value. Their successful completion would likely lead to a step change in the company's revenue and EBITDA generation.
Okay.
Crucially, it would also significantly increase the contribution from non-Argentine sources. This would help rebalance the company's geographic risk profile, reduce that dependency on Argentina, and potentially justify a higher valuation multiple for the stock over time.
But there's risk, right? Big projects always have risk.
Absolutely. It's important to acknowledge the execution risk here. There's always potential for construction delays, cost overruns, regulatory hurdles. The ultimate success or failure of these 2 massive projects will likely be a primary driver of the stock's performance over the next 5 to 7 years. They need to get these right.
Okay. Beyond these organic improvements and the major capital projects, is CAP looking at any inorganic expansion like M&A? Are they actively seeking to acquire more airports to add to the 52?
Yes, they have an explicit strategy to pursue inorganic growth through mergers and acquisitions. They've actually strengthened their dedicated M&A team and are actively evaluating opportunities on a global scale.
Where are they looking?
Management has identified the Middle East, Africa, Latin America, and Europe as target regions for expansion. In fact, they are currently actively competing in concession bidding processes in Angola and Montenegro, which demonstrates their intent to execute on this M&A strategy.
Okay, actively bidding now. What's the rationale?
The value proposition here is to leverage their deep operational expertise gained over decades in new geographies. Ideally, perhaps, in markets with more stable political and economic backdrops than their core Argentine market. Success in this area could further diversify the company's cash flow streams and reduce its overall risk profile.
So it's all about growth and diversification, which sounds like a solid plan on paper. However, we've hinted at it throughout this deep dive. The elephant in the room, Argentina. Let's really dig into the risks there and any other potential headwinds facing CAAP.
You're right. Argentina is absolutely central to CAAP's risk profile. It accounts for the majority of the company's airports and, critically, the majority of its earnings. You can't analyze CAAP without analyzing Argentina.
So what's the first major risk category there?
The first is just broad macroeconomic risk. Argentina has, as you know, a long and painful history of economic crises. The current administration under President Javier Milei has embarked on this radical shock therapy program.
Right, the headlines have been dramatic.
Extremely. Trying to combat triple-digit inflation and chronic fiscal deficits. Now, there are some early indicators of maybe success. Inflation is slowing from its peak, over 200%. They achieved a fiscal surplus in early 2025. But the situation remains extremely fragile.
Fragile how? What are the downsides of the shock therapy?
Well, these austerity measures have caused a severe economic contraction. The economy shrank significantly. The poverty rate is now reported to be above 50%. This creates fertile ground for social unrest and protests, which could potentially disrupt airport operations or just the general business environment.
So even with some positive fiscal signs, the ground underneath them is still shaking quite a bit. What about currency risk? How does the volatility of the Argentine peso impact CIP, which reports in U.S. dollars?
Currency risk is another huge factor. The Argentine peso, the ARS, is notoriously one of the world's most volatile currencies. Sharp devaluations directly impact CIP's reported U.S. dollar earnings and cash flows. When the peso falls, their translated earnings fall.
Even with that single till protection you mentioned.
Well, while the single till concession in Argentina does offer that long-term IRR protection, there can be significant timing mismatches. Inflation might drive up local costs quickly, but getting tariffs adjusted to compensate can take time. This lag can lead to intra-margin compression.
Okay, a timing issue.
And furthermore, historically, Argentina has imposed strict capital controls, limiting or even preventing companies from repatriating cash out of the country. That risk remains until the economy is fully stabilized, and those controls are demonstrably gone for good. Your cash could get trapped.
Wow, okay. And then there's the political side of things. You've highlighted political stability as a critical vulnerability. For Argentina, that feels like a massive understatement right now. How genuinely fragile is the Milei administration, and what are the immediate tangible risks for CAP if their reforms falter or if social unrest escalates?
That leads directly to political risk. It's significant. President Milei's administration governs without a majority in Congress. This makes passing crucial structural reforms exceedingly difficult. He relies on decrees and negotiation, which is inherently unstable.
Right. Governing by decree isn't easy long term.
No. And the political landscape is highly polarized. There's strong opposition. The midterm legislative elections, scheduled for October 2025, represent a critical test of the government's public support and political viability.
So the midterms are key. What if they go badly for Milei?
A core electoral result could render the administration a lame duck, significantly weakening its ability to govern or push reforms. Worse, it raises the risk of a policy reversal towards a more interventionist state model upon a change in government down the line. So, frankly, an investment in CIAP today is an implicit bet on the success and, importantly, the continuity of the current market-friendly reform agenda in Argentina.
That's a huge roll of the dice for any investor. Are there jurisdictional or regulatory headwinds beyond Argentina that they need to contend with, or is Argentina truly the sole major concern?
Argentina is definitely paramount, but there are distinct regulatory risks in other key markets, too. In Brazil, for instance, the regulatory framework for airport concessions has evolved over 7 different bidding rounds. While it's generally perceived as stable, government changes can lead to shifts in regulatory priorities or approaches to tariff setting. It's not completely static.
Okay.
Also, the Brazilian government's new Ampliar program, which aims to concession out up to 100 smaller regional airports, could create new opportunities, but it might also alter the competitive landscape in ways that are hard to predict right now.
And Italy and Armenia, the risk there is mostly execution.
For Italy and Armenia, yes. The primary risk is simply execution risk for those massive planned capital projects we just discussed. Securing and maintaining all necessary government approvals, permits, and political support for the Florence and Zvartnots expansions is paramount. Any significant delays or roadblocks could jeopardize the expected returns on these really critical investments. These are massive, complex undertakings.
Makes sense. And finally, what about financial and operational risks more broadly, like debt or their reliance on airline partners?
On the financial side, yes. While CAP's current leverage is low, that forthcoming cycle of heavy capital expenditure for its major projects in Italy and Armenia will require substantial financing.
They'll need to borrow more.
They likely will.
Mm-hmm.
The company's ability to access global and local capital markets at favorable rates will be crucial. A deterioration in Argentina's sovereign credit profile could potentially increase CAP's own cost of capital and make refinancing harder down the road. For example, they have $350 million in senior notes due in 2027 that will need to be addressed, either refinanced or repaid.
Okay, debt maturities to watch.
Operationally, like all airport operators, CAP is dependent on the financial health and the route strategies of its airline partners. A major bankruptcy of a key airline customer or a significant reduction in service to its airports could negatively impact traffic volumes and revenues. And while direct airport competition is minimal due to their monopolies, CAAP does face some indirect competition from alternative modes of transportation. Think long-distance buses or, where available, high-speed rail, particularly on shorter domestic roads.
Wow, so even with this formidable business model, the Argentine risk alone turns it into what sounds like a high-stakes bet on the future of an entire country. That's a huge consideration for any investor. Given all these moving parts, the growth, the risks, the complexity, how do you even begin to value something like that?
You've hit on the core challenge. The valuation of Corporation América Airports is indeed a complex exercise. Precisely because you have to account for its diverse portfolio, those varied regulatory regimes across countries, and of course the significant risk premium associated with its primary market, Argentina.
So no simple answer.
Definitely not. A multifaceted approach is really necessary. You need to incorporate relative valuation, intrinsic valuation, and probably a sum-of-the-parts methodology to get a full picture.
Okay, so starting with relative valuation, how does CAAP stack up against its peers? Are we seeing a clear discount because of all this complexity and risk?
Yes, very much so. The most direct public market comparables for CAAP are the publicly listed Mexican airport operators, Grupo Aeroportuario del Pacífico, PAC, Grupo Aeroportuario del Sureste, ASR, and Grupo Aeroportuario del Centro Norte, OMAB.
Okay, the Mexican operators, why them?
Well, these companies operate in a similar industry, private airport concessions. But crucially, they operate within a generally more stable political and macroeconomic environment in Mexico compared to Argentina.
Right, so a good benchmark.
Exactly. And a comparative analysis consistently shows that CAAP trades at a significant valuation discount to these Mexican peers on key multiples, like enterprise value to EBITDA, and price to earnings, PE.
How significant is that discount, roughly?
Well, one analyst report we looked at, for example, noted that CAAP was trading at approximately a 25% discount to the average of its Latin American peers based on estimated 2026 EBITDA.
25%, that's substantial.
It is. And this discount isn't arbitrary. It's arguably a rational market reflection of the elevated risk profile stemming from CAA's heavy concentration in Argentina. The central investment question for you, the listener, is whether the current discount adequately compensates for that incremental risk.
Right. Is it enough of a discount?
Exactly. A bull would argue it's excessive and will narrow if Argentina stabilizes. A bear would argue it's justified, or maybe even insufficient, given the potential downsides.
Can you give us some specific numbers to highlight this valuation gap with its peers? How stark is the difference in those multiples?
Certainly. Let's look at some last 12 months, or LTM, figures. CAAP's EV/LTM EBITDA is around 6.2x. Its LTM price to earnings, or PE, is about 18.4x.
Okay, 6.2x and 18.4x for CAP.
Now contrast that with its Mexican peers. Grupo Aeroportuario del Pacífico, take A, trades at a much higher 11.5x EV/LTM EBITDA and 26.7x LTM PE.
Big difference.
Huge. Grupo Aeroportuario del Sureste, ASR, is at 9.0x EV/LTM EBITDA and 13.5x LTM PE, a bit lower on PE but still higher on EBITDA. And Grupo Aeroportuario del Centro Norte, OMAB, is at 10.1x EV/LTM EBITDA and 21.7x LTM PE.
So across the board, COP is trading lower, often significantly lower.
Yes. You can clearly see the ARP is trading at a notable discount, even though it actually has a lower net debt profile than some of those peers. This really highlights how the market is pricing in that inherent Argentine risk.
That puts the discount in stark relief. What about intrinsic valuation, like a discounted cash flow DCF analysis? How sensitive are those models, especially with all these macroeconomic variables flying around?
A DCF analysis provides a theoretical framework for value, absolutely, but its output is highly sensitive to several challenging assumptions, especially for a company like SEA.
Like, what kind of assumptions?
Well, first, traffic and revenue forecasts. These have to be built on a country-by-country basis. For Argentina, this requires taking a view on President Milei's economic reforms actually working. Forecasting GDP growth, which some project could rebound to over 5% in 2025 after the contraction, but that's a big if.
Right.
And for Italy and Armenia, your forecast must incorporate the expected step change in capacity and traffic from those major expansion projects, but only after 2028 when they're supposed to be completed. So you're forecasting way out.
And margins, how do you forecast those?
Exactly, margin assumptions. Future EBITDA margins will be a function of passenger mix, more LCCs, the growth of high-margin commercial revenues, will their strategy work, and the company's ability to control costs, especially against that backdrop of potentially high inflation continuing in Argentina.
Lots of variables.
And finally, maybe the trickiest part, the cost of capital, or WACC. This is a major analytical hurdle. Using a single, blended WACC for the whole company would be inappropriate given the diverse risk profiles of operating in Italy versus Argentina versus Brazil.
So you need different discount rates.
A more rigorous approach requires calculating separate WACCs for each country, incorporating specific country risk premiums, which would be exceptionally high for Argentina, and then weighting them based on their contribution to the business. It gets complex quickly.
It sounds like a lot of moving parts and highly subjective inputs for a DCF. Is there a more holistic valuation methodology that analysts find more suitable for a complex company like CAAP, one that truly breaks down its disparate parts?
Yes, given the complexity of some of the parts, or SOTP, valuation is arguably the most suitable methodology for a complex holding company like CAAP.
Some of the parts, how does that work?
This approach involves essentially breaking the company down into its constituent parts or segments and valuing each segment individually, using the most appropriate method for that part before summing them all up to get a total value.
Okay, so valuing Argentina separately from Italy, for example.
Yeah. Exactly. For CAAP, a logical segmentation would be by country or region, reflecting those different regulatory regimes and risk profiles. For Italy, you could value its airports using peer multiples from other European airport operators, given it's a more stable, comparable market.
Makes sense.
For Brazil, Uruguay, and Ecuador, you could perhaps use a DCF model specifically tailored for inflation-linked emerging market infrastructure assets, reflecting their regulatory models.
Okay.
And then for Argentina and Armenia, you'd likely use a high-risk DCF model that explicitly reflects the single-till regulatory structure and the significant political and macroeconomic risk embedded in those operations.
And the benefit of doing all that work.
The benefit of summing these individual valuations is that it can help estimate the company's total enterprise value in a more granular way. And crucially, it can help quantify any potential holding company discount the market might be applying due to the overall complexity of the structure and that overshadowing risk from Argentina. It allows for a more nuanced view than just applying one multiple to the whole thing.
That makes a lot of sense for a company with such disparate assets and risks. But ultimately, who is at the helm steering this ship through these complex waters? Let's talk about the management team and the governance structure. How solid are they?
Right. The quality and experience of the leadership team, coupled with a sound governance structure, are absolutely critical factors for a company as complex as CAP. Their ability to navigate these volatile political landscapes and execute those large-scale projects rests heavily on the management.
So who's in charge? Are they experienced?
CAAP is led by a pretty seasoned team. Their CEO, Martin Yernikian, has been with the company for approximately 20 years now. He's held various roles and actually led many of the processes for acquiring and developing their current airport portfolio.
20 years. That's deep experience in this specific company and industry.
It is. That long tenure provides incredible continuity and invaluable institutional knowledge in a business that's really built on long-term relationships and understanding specific local contexts.
That seems like a huge advantage, especially in an industry that relies so heavily on government relationships. What does their track record show about their strategic vision and how they allocate capital? Are they making smart moves?
I'd say they've demonstrated a strong track record in both strategic decision-making and operational execution over the years. Remember, they successfully built this global portfolio, essentially from their initial base of 33 airports acquired in Argentina way back in 1998.
Right.
Their key capital allocation decisions highlight, I think, a clear long-term strategic vision. For example, successfully negotiating those long-term extensions for their most critical assets in Argentina out to 2038 and in Uruguay to 2053 that secures decades of future cash flows. That's smart management.
Locking in the core assets. What else?
They've also shown disciplined portfolio optimization. Remember this strategic divestment of their interest in 5 Peruvian airports back in 2021? That allowed them to refocus resources on what they saw as core, high-potential assets. And in a really savvy move, the friendly termination of that natal concession in Brazil actually resulted in a substantial indemnification payment back to CA of over $160 million. That effectively unlocked value for shareholders from an asset they exit.
Turning an exit into cash.
Exactly. And finally, the initiation of those ambitious, transformative expansion projects in Florence and Armenia that signals management's confidence in their ability to execute large-scale developments and drive future growth. Truly, this history of successful negotiation with government partners across numerous political cycles is a significant intangible asset.
So they clearly have experienced hands on the wheel making some strategic plays. What about the governance structure itself and how it aligns with shareholders? Is there a risk that minority shareholders, the public investors, have limited influence?
Okay, governance. Corporation América Airports is structured as a public limited liability company, technically a Société Anonyme, incorporated in Luxembourg. Its common shares are listed on the NYSE under CA.
Luxembourg Incorporation, NYSE listing. Got it.
Yep. Their board of directors can have up to 9 members. Currently, they have 7. And of those 7, 3 members, or about 43%, are classified as independent.
Okay, less than half independent.
Correct. As a foreign private issuer, CAP is exempt from some NYSE corporate governance requirements that apply to U.S. companies, but it is subject to SEC rules, particularly regarding the composition and function of its audit committee.
And who controls the company? Is it widely held?
No, the company is controlled by ACI Airports, S.A.A.L., which is part of the broader Corporation America conglomerate, founded by Eduardo Yernikian, Martin's uncle.
Ah, so it's family conglomerate control.
Yes, and while this does mean that public minority shareholders have limited influence on major corporate decisions, it's important to note that no significant red flags concerning related party transactions or major conflicts of interest were identified in the analysis we reviewed.
Okay. And management seems aligned with value creation.
Broadly, yes.
Mm-hmm.
The management team's stated strategic vision appears aligned with creating long-term value for all stakeholders, even within that controlled structure.
All right. Now that we've unpacked every facet of CIP, the business, the regulation, the finances, the risks, the management, it's time to look at the 2 sides of the coin, the bull case and the bear case. What's the optimistic scenario for this company? What needs to go right for it to be a compelling investment from here?
Okay, the outlook. The investment thesis for CAAP is definitely subject to a wide range of potential outcomes, primarily driven by, no surprise, Argentina's future and the execution of those big growth projects. The bull case, the optimistic scenario, rests on several key factors falling into place. The absolute core of this case is a successful Argentine economic turnaround.
Everything hinges on Argentina improving.
Pretty much for the bull case to fully play out. If President Milei's shock therapy leads to sustained fiscal discipline, a durable reduction in inflation down to manageable levels, and a stable market-based exchange rate, the impact on CAAP would be profound.
How profound?
A stable, growing Argentine economy would naturally boost passenger traffic. But critically, a stronger, more stable peso would translate into significantly higher U.S. dollar-denominated earnings and cash flows when they report results. This alone could trigger a substantial re-rating of the company's valuation multiple, potentially closing that big discount we saw compared to its more stable Mexican peers.
So the fortunes of the company are directly tied to the success of the country's economic reforms. What else makes up this optimistic bull case beyond just Argentina?
The bull case also assumes flawless execution of the growth projects. This means those major expansions at Florence and Zvartnots airports are completed reasonably on time and within budget.
Big if for projects that size.
It's a big if, but it's key to the bull case. If these new, higher capacity facilities come online smoothly post-2028, they would lead to a step change in non-Argentine revenue and EBITDA generation. Successful execution would not only boost overall earnings significantly, but also materially de-risk the company's profile by reducing its reliance on Latin America. That could make the stock much more attractive to a broader base of global infrastructure investors.
De-risking through diversification. Makes sense. What else?
Furthermore, the bull case envisions effective non-aeronautical monetization. This means management successfully executes its strategy to grow those high-margin commercial revenues across its portfolio, things like the big duty-free expansion at Ezeiza, the real estate development in Brazil. If they succeed here, it drives higher revenue per passenger, expands overall EBITDA margins, and enhances free cash flow generation.
Getting more money out of each passenger.
Exactly. And finally, the bull case might include some accretive M&A. This is where TFP leverages its strong balance sheet and operational expertise to win new, attractive airport concessions in its target markets, maybe in Africa, the Middle East, or Europe, further diversifying its cash flow streams and bolstering its global footprint.
That's a compelling vision of potential upside, clearly illustrating what the company is striving for. It paints a picture of a much larger, more diversified, and more valuable company. But as we've discussed extensively, there are significant risks. What does the bear case look like? What could go fundamentally wrong here?
Right, the bear case, the pessimistic scenario, would materialize if one or more of the company's key risks really come to fruition. The most significant and potentially destructive risk is, again, an Argentine economic and political crisis.
Argentina falling apart again.
Exactly. In this scenario, the Milei administration's reforms fail to gain traction, or they get derailed by political opposition and social unrest. Argentina could relapse into hyperinflation, suffer another sovereign debt crisis, and potentially impose draconian capital controls again, trapping CAAP's cash within the country.
And the government could interfere with the concession.
That's a major risk in a crisis. A new, more interventionist government could seek to unilaterally and unfavorably renegotiate the terms of the main AA2000 concession agreement. That would severely impair the value of CAAP's primary asset and be catastrophic for the company's valuation.
That's a worst-case scenario for Argentina, with direct, severe consequences for CAAP. What other risks feed into the bear case, looking beyond Argentina itself?
Another major concern for the bear case is a major CapEx blunder. This means those transformative projects in Italy and/or Armenia encounter significant problems.
Like what kind of problems?
Major construction delays pushing completion back years, substantial cost overruns that strain the balance sheet and require more debt or equity, or even a failure to secure final regulatory approvals needed to operate the expanded facilities.
What's the impact if those projects fail?
Such a failure would not only result in a likely write-down of the capital invested, but would also mean that the anticipated de-risking of the company's geographic profile doesn't happen. CAP would remain heavily exposed to Argentina, just having spent billions trying to diversify.
Ouch. Any other big bear points?
Well, the bear case could also include a prolonged global or regional downturn. A sharp global recession or a specific economic crisis hitting Latin America hard could severely curtail that secular growth in air travel we talked about. A sustained period of declining or stagnant passenger traffic would pressure CAP's revenues and profitability, making it potentially more difficult to service its debt and fund its ongoing capital expenditures.
So a macro shock hitting travel demand.
Exactly. And finally, there's always the risk of adverse regulatory changes in key markets outside Argentina, like Brazil or Italy. A shift in the political or regulatory environment could lead to less favorable tariff reviews down the road, or other measures that limit the company's profitability and its return on invested capital in those countries.
We've truly taken a deep dive into CAAP today. We've uncovered a really fascinating company that is, at the same time, both a robust infrastructure play with strong moats and a venture that's just intricately tied to the macroeconomic and political currents of Argentina. It's a company with a strong recovery story behind it, some really ambitious growth plans, particularly in Europe, and that formidable competitive position. But it's also facing these significant, highly concentrated risks, mainly tied to Argentina.
That sums it up well. At its heart, I think an investment in CF10 today is really a leveraged play on the long-term economic trajectory of Argentina. That's the main bet. But it's coupled with, let's say, a call option on the successful execution of its major European and Armenian growth projects.
A leveraged bet with an option attached.
Kind of. And its experienced management team and that strong balance sheet provide critical buffers against some of the volatility. But the outsized influence of its core market, Argentina, will likely remain the dominant factor in its risk-reward profile for the foreseeable future.
So as you, our listener, consider this multifaceted profile we've laid out, maybe ask yourself, how much of a premium do you place on the stability and predictability often associated with regulated infrastructure versus the high growth but also high risk potential tied to an emerging market turnaround like Argentina? Is investing in CAAP a calculated risk for potentially significant future rewards, or is it more like a leap of faith into a future that's still quite uncertain?